website and the blog post you initially released on January 28th, your financial requirements with your clearinghouse are not mentioned. You only mention market volatility. And when I review the Robinhood customer agreement, you don't include specifics on how and when you may decide to restrict trading, which you did. And you don't include any language or disclosures regarding your capital requirements. It only includes vague language that at any time and in its sole discretion, Robinhood can restrict trading. In other words, you seem to reserve the right to make up the rules as you go along. So I have two questions for you. First, do you think you owe your customers more disclosure and transparency than you gave them? And second, do you believe your lack of candor with your customers might have contributed to the wild speculation and confusion that resulted in the aftermath of your trading restrictions?
Congresswoman, I appreciate the question. So to answer the second question, look, I'm sorry for what happened. I apologize, and I'm not going to say that Robinhood did everything perfect and that we haven't made mistakes in the past. But what I commit to is making sure that we improve from this, we learn from it, and we don't make the same mistakes in the future. And Robinhood as an organization will learn from this and improve to make sure it doesn't happen again. And I'll make sure of that.
Well, I expect we will experience future events with increased volatility, and Robinhood's recent actions appeared arbitrary, which is why I don't blame customers for feeling treated unfairly. Your trading restrictions came out of the blue, and your communication was not clear. So my next question, Mr. Tenev, looking forward, what operational changes is Robinhood making to better respond to future market volatility, to improve transparency with your customers, and to ensure retail customers don't get the rug pulled out from under them at the last minute?
Thank you for that question, Congresswoman. We'll be committing to reviewing absolutely everything about this. The $3.4 billion that we raised, I think, goes a long way to cushioning the firm from future market volatility and other similar black swan events. And I believe that even throughout this process, we improved our risk management processes and strengthened them so that the experience customers had Friday of that week was much improved from Thursday.
Thank you.
We'll continue to learn and improve upon this.
Ms. Wagner, you're recognized for
Thank you, Madam Chairwoman. I'd like to welcome our witnesses for testifying today to discuss the late January market volatility that took place, along with what I hope is a broader discussion on market functions and their effect on everyday investors. Since I was very first elected, I have advocated for America's Main Street investors and worked tirelessly to ensure that all Americans, especially those low and middle income savers, are giving the investment choice, access, and affordability that they deserve. Retail investors are the strength of our stock market, and I have fought throughout my career for their best interests in the financial markets. And this hearing today is no different. The advances in financial technology that we've witnessed in the last decade have improved the way that Americans and our businesses perform financial activities. In just the past year, we have seen retail investors' market participation more than double. And I think this is great. I believe in the wisdom of the retail investor, and I will say I believe in the First Amendment too. This increase is attributed to Robinhood and other trading brokerages who are lowering account minimums, permitting fractional share trading, and implementing zero commission trading. It is critical that Congress focus on reducing barriers to market participation, which is rarely wants to do, let me sadly say, and allowing Main Street Americans access to the financial instruments that can create long-term investment savings. All of these changes have given millions of Americans the ability to invest better for their families and their future. My hope is that the majority does not use this hearing as an excuse to once again add new federal regulatory burdens to an industry that is already heavily regulated, that will prevent people from participating in our capital markets. Letting existing regulations work is key, not burdening everyday investors with new and more costly barriers to entry. Mr. Tanev, it appears at the time your company did not have enough money to meet the collateral requirements for that level of trading by your customers. In your view, A, were collateral requirements from the DTCC unreasonably high? Was the amount of trading on your platform unforeseeable? Or was your company undercapitalized given its risk profile?
Thank you for the question, Congresswoman. So this event was a 5 Sigma event, which is a 1 in 3.5 million event. To put that in context, there have only been tens of thousands of stock market days in the history of the US stock market. So a 1 in 3.5 million event basically is unmodelable. That said, we can learn from it. And in this particular case, our risk management processes worked appropriately to keep us in compliance with all of our deposit requirements and collateral requirements.
Well, Mr. Tanev, I realize that you are doing a full review of your practices and such. I encourage you to do that. And certainly communication with your investors is going to be key to that because you didn't communicate with them early on. Let me just say, as the ranking member on the Diversity and Inclusion Subcommittee, I am delighted to be speaking with our witness, Ms. Jennifer Schultz. Ranking Member McHenry and I have spent countless hours stressing the importance of having qualified women in finance. So I'm pleased to have you here today to lend your expertise. Ms. Schultz, we now know that it was the daily collateral demands set by the National Security Clearing Corporation that were the reason Robinhood had to temporarily restrict trading. Can you briefly explain the purpose of these capital requirements and their overall relationship to ensuring our markets function in an orderly manner? And did you see any broad failures of market function during these events, ma'am?
Sure. Thank you. Thank you for the compliment. The NSCC's collateral requirements here serve the function to provide security for the stock settlement process goes through. So while an investor thinks that what has happened is they bought a stock on the day that they make a trade, it really takes 2 days for the settlement process to clear. During that time, the brokerage firm, the DTCC, and the brokerage firm on the other side can remain at risk of that stock not actually clearing. And the collateral requirements are in place in order to mitigate the risk that the brokerage firm will not be able to make good on its promises to sell or buy. I didn't see any broad-scale failure here. The DTCC's collateral requirement was large, but understandable. And I think things functioned largely correctly.
My time has expired. I thank you all for your testimony, and I yield back, Madam Chairwoman.
Thank you very much.
Madam Chairman, point of order. I just like, Perlmutter, just to remind people to, when they're not speaking, to mute themselves, because there's a lot of feedback when the question is asked and the mic stays open and the people are answering the question. Just remind everybody, mute when you're not speaking, that's all.
Thank you very much. You heard Mr. Perlmutter. I would hope that every member would certainly do that. Mr. Sherman, you're recognized for 5 minutes.
Thank you very much. We've come to expect things on the internet to be free. When you're not paying for it, it's not free. You're the product, someone else is the customer. When you go onto Facebook and it's free, you're the product being sold to the advertiser, and your information is sold to God knows whom. So we now have a system where we're telling investors that it's free to invest to buy and sell stock. there are two ways to pay the folks involved in Wall Street for buying and selling stock. One is a commission, and you know what it is. And so we discourage investors a little bit from buying and selling stock because they have to pay a commission and they know they're paying a commission. The other way to do it is to give them a worse execution. Whenever there's a stock being purchased and sold, the market maker, perhaps Citadel, might be willing to sell the stock for $10.05, but will buy it for only $10. The difference is 5 cents. And so the issue is whether Robinhood and other people who are being told you get it for free are really getting it for free. Mr. Griffin, you're a market maker. You pay some brokers for order flow. You don't pay others for order flow. So when you pay for order flow, you're not making as much on the transaction. You have to pay some of that back to the broker. That's hidden the amount of that is hidden from the customer. The fact that it exists has perhaps recently been disclosed. SEC rules require that people get the best execution, but I've recently learned that there's best execution and enhanced pricing. So if you get an order from Fidelity and you get an order from Robinhood and you're paying for the Robinhood order flow, is the Robinhood customer getting as good a price as the Fidelity customer? Mr. Griffin.
So, Congressman, I believe that's an excellent question. The execution quality that we can provide as measured in terms of price improvement is heavily related or correlated to the size of the order that we receive. So if I were to speculate,
don't tell me that that there are other factors involved and take us down another road. I'm asking you a clear question. Assuming same size of order, one comes in from Robinhood, one comes in from Fidelity. Is it not true that one is going to get a enhanced best execution, and the other one is just going to get best execution?
So as I was trying to explain, because the Robinhood order comes from a community of traders who tend to trade in smaller size.
That isn't my question, sir. You're evading my question by making up other questions. Let me repeat. 2 identical orders come in. Same stock, same quantity. One's from Robinhood, one's from Fidelity. What happens?
The quality of the execution varies by the channel of the order. This is a commonly understood phenomena in economics that channels matter. So, for example, when you go get a mortgage from JP Morgan to their clientele has a different rate of interest than a mortgage.
Okay, reclaiming my time, sir. Who gets the better deal? Well, one that comes from a broker who is being paid for order flow, and one not. Can you testify that on balance, there is no difference, assuming the same size of the order?
So, as I said earlier, size of the order is only one factor.
You are doing a great job of wasting my time. If you're going to filibuster, you should run for the Senate. Everyone else I've talked to in this industry says when you pay for order flow, you get when your broker is being paid for order flow, you get a worse execution. Otherwise, you're in a peculiar circumstance where you're making more money on a Fidelity transaction than a Robinhood transaction, which would be an absurd business practice.
The gentleman's time has expired. Mr. Lucas, you're recognized for 5 minutes.
Thank you, Madam Chairman, for holding this hearing, and thank you to the witnesses for agreeing to testify. It's been reported that approximately 20% of market volume is now attributable to retail customers, which I think is just fascinating considering that's up from 10% in 2019. And that's an overwhelmingly positive development. allowing for more market liquidity, more stability, additional avenues for households to grow their wealth. And it's important to increase market access for retail customers. And I don't want to disrupt that if we possibly can. So I'd like to turn with my first question to Mr. Teniff. Let's talk about the attention that this pay for order flow has received. You explained in your testimony, Robinhood's relationship with market makers is important for Robinhood's ability to offer commission-free trading. So expand, if you would, on how that process benefits the everyday investor. And just expand in general on that, if you would.
Congressman, I'd be happy to. Thanks for giving me an opportunity. So as I mentioned in my written testimony, payment for order flow enables commission-free trading. Prior to Robinhood changing the industry standard model to be commission-free, most brokers collected a commission on top of the payment for order flow on every transaction. Now, Robinhood routes to market makers, including Citadel Execution Services. We've got 7 in total across equities and options. And we route without consideration for payment for order flow. All payment for order flow arrangements are uniform across the market makers. And our system routes orders based on who provides the best execution quality for our customers. So the reason Citadel gets a relatively high percentage of our customer order flow is because they provide superior execution quality for our customers. And that's first and foremost the most important consideration that we look for. How are our customers getting the best execution quality? If another market maker were to improve upon the execution quality that Citadel Execution Services provides on any subset of orders, our system is set up to automatically route more traffic to that market maker.
Continuing down this line, because clearly this is one of the things that my colleagues and the public has a very strong interest in. And having lived through Dodd-Frank before, I see where sometimes major things can occur. I want to turn to Mr. Griffin. Now, could you also elaborate on how payment for order flow provides, whether it's the best price to the retail investor from the market maker perspective? Could you expand on that? As you outlined in...
Absolutely, Congressman. So as the CEO of Robinhood just set forth clearly, the orders that are allocated amongst the market makers today are allocated principally on the basis of price improvement. We have fought for 15 years to make that the basis by how which orders are allocated, because we strongly believe that Citadel is able to provide a better execution for retail orders in the long run. We make a huge investment in our team and our technology to do so. How is it that we are able to provide better execution quality than exchanges? Because exchanges are limited in their ability to do business by regulatory mandate. Exchanges by law have a minimum 1 cent wide market, which for low price securities means that they are less competitive than they otherwise could be. We're able to
How are you here and what are you doing?
Excuse me?
That wasn't either one of us. Continue, Mr. Griffin.
All right. So we're able to share our trading acumen with retail investors, and we're able to give them a better price, and we're able to make payments for order flow to firms like Robinhood that allow them to have lower, or today in most cases, no commission. And of particular note, we're able to help Robinhood and other brokers pay exchange fees to the exchanges at the time of execution. This has been very important to the democratization of finance. It has allowed the American retail investor to have the lowest execution cost they've ever had in the history of the U.S. financial market.
Kind of in the Dodd-Frank process that the chairman and I went through a decade ago, plus there was much discussion about margin requirements. Give us just a discussion for an instant about when you discovered you had a $3 billion additional margin call.
So, thank you, Congressman. I believe the full play-by-play of that situation was described in detail in my written testimony. Just to clarify, though, this decision had nothing to do with margin.
Expired, unfortunately. Thank you, Madam Chair. I yield back.
Has expired. Mr. Meeks, you're recognized for 5 minutes.
Thank you, Madam Chair.